Good afternoon, everyone. Happy New Year. Thank you so much for joining us this afternoon for our first session in 2025 on what is, I think, a great topic to kick off the year, which is how to generate consistent income in your portfolio. We're going to go over the top three income strategies that you can use in your portfolio to generate income for 2025. And predominantly, what we want to spend our time on is helping you understand the range of strategies that you can use in your portfolio to generate income utilizing options, whether you are a long-term investor, whether you're a short-term speculator. We want to make sure that you have the knowledge and the tools to be able to generate income in your portfolio this year. So, what we are dedicated here during these Thursday afternoon sessions, which I see many of you have already chimed into the chat window here, is a session that we host every single Thursday, focused on helping you sustainably and confidently grow your trading account in the long run. As you can see, we have a vibrant community of traders that join us every single Thursday on these sessions to help you better understand how to grow your account, which is more than just learning about options. It entails everything from technical analysis, fundamental analysis, trading psychology, and just the mindset that you think about options trading. Those are all really important in your ability to succeed. So if you're joining us for the first time, please feel free to say hi into the chat window. As you see, there are people coming in from all over the world. I saw Atlanta, I saw Australia, I saw Germany, I saw plenty of people from the US and Canada. So please feel free to chime in, tell us who you are, where you're from, because these Thursday education sessions are dedicated to help you sustainably grow your account. And what you can expect from our trading sessions is really one of three categories: essential, seasoned, or mastery. And today, what we're going to focus on are the top two sessions, which are essentials, kind of the parts of the wheel strategy, understanding calls and puts, and some of the seasoned stuff within credit spreads. We're going to cover kind of a variety of trading for both beginners and seasoned traders. And even if you are have plenty of experience trading, I think you'll learn quite a bit from today's session. Now, before we jump into it, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that you'll see during today's session as a recommendation. So what we're going to focus on today is number one, just understanding kind of what it takes to consistently generate income in a portfolio, kind of set the ground rules for how do we approach any of these specific strategies. Then we're going to dive into the top three strategies, and that covers the number one most underutilized strategy. This is one that I think that every investor who has a portfolio should be using, but many of you do not yet today, which is why I want to focus on that first. Then we'll talk about the number one most popular income generating strategy. And then we're going to talk about the number one directional strategy. How can you take a directional view in the market and generate income doing so? Then we're going to cover the best practices for each of these strategies and then show you how to find the optimal trading signals for each one of those three, meaning how can you find the highest yielding opportunities from an income perspective for all three strategies that we're going to go over today. And then at the end, we'll open this up for Q&A. But my goal here today is to help you master the top three income generating strategies to help you consistently generate income. And we're going to go over two things. We're going to go over theory, meaning understanding the mechanics of each strategy and kind of how they generate income for your portfolio. And then more importantly, talk about best practices. What are the rules for trade entry? What are the rules for exit? Those are the things that are going to help you master these types of strategies for 2025. But we're going to cover a lot of things during today's session. So if you want a copy of today's recording and slides, you just have to either have a free trial or a membership, and we'll send you both when we publish it this Thursday. I'm sorry, this weekend. And if you don't have access to either a free trial or a membership, you can sign up for your free trial by pointing your phone to that QR code on your screen or going to optionsplay.com/sign up. It takes literally 10 seconds to sign up for a free trial. There's no credit card required. It will give you access to the tools that we're going to show you here today, meaning how to find the trading signals for the highest yielding opportunities for the income strategies. This will give you access to the platform that will automate the searches for you, as well as a a copy of today's slides and the recording from today's session so that you can watch it at your own pace, follow along, and then utilize the tools that we have here at OptionsPlay to implement the strategies that you're learning during today's session. Okay, so let's jump right into it and talk a little bit about what does it take to generate consistent income with options. And first and foremost, it's important to understand that whenever you are trying to generate income using options, what you're doing is you're selling an option. And what you're doing is that you're collecting income in exchange for taking on an obligation. So it's important to understand what those obligations are and what they mean and make sure that you are comfortable with those obligations in order to generate the income. It's a matter of selecting what obligations are you comfortable with versus how much income are you looking to get. And what we want to try to do is understand the best practices for each type of strategy. So with each one, you're going to have different rules for trade entry and trade exit. You have to just understand what they are. And they're pretty much black and white, meaning there's been a lot of back testing on these types of strategies. There's not a lot of gray area with regards to what are best practices for these types of strategies. So it's about understanding the rules and following the rules. So in order to generate consistent income, what you're doing is you're simply systematically applying the rules of each of the strategy day in and day out. Doesn't matter whether the markets are down, markets are up, volatility is high, volatility is low. You want to apply the same rules day in and day out if you want to get consistent results from these types of strategies. You don't want to have a lot of subjectivity, a lot of, I think the market is going to do this, so maybe I'll adjust it this way. You want to keep things consistent day in and day out, week in, week out, month after month, if you would want to generate that consistent income. And this simply requires either monthly or weekly maintenance of your positions. And that depends on your preferences in terms of how frequently you like to trade. Some of you could trade weekly options and do it more frequently. Some of you have less time and you're doing monthly options and you're managing them less. So it's a matter of picking a schedule that works more for you and trading on that specific schedule. But the systematic process doesn't change regardless of how frequently you trade. You must apply the same rules day in and day out, regardless whether the position's up or down, markets are up or down, whether volatility is high or low. Okay, so let's jump right into it. We're going to cover two at the same time: the number one most underutilized option strategy and the number one most popular option strategy. And this is really what is typically referred to as the wheel strategy, many of you know, which is selling put options to acquire stocks that you want to purchase. And once you've purchased those shares, selling cover calls to generate income on the asset until the asset rises high enough to a point where you want to take profits on that. And what you do is you then, once you sell your stock, you get cash. And what you do is you take that cash and you put it back into the next investment. So it's called the wheel strategy because you're doing it over and over and over again. Now, most of you are probably at some or have heard of or familiar with the concept of a cover call strategy, which is by far the number one most popular strategy. But a strategy that goes hand in hand with a cover call, which is a cash secured put, many of you do not utilize, even though you might sell cover calls in your portfolio, which is why I call it the number one most underutilized strategy. And what you're going to see is that today, during the examples that I give you, is that you can generate far more income selling cash secured puts than you can on cover calls because of the mechanics of the strategy. And most people don't realize how much income they are not receiving by not selling puts on the investments that they want to purchase. Many investors may not even realize how much income they're missing out by not selling cover calls, but what you'll see is that by not selling cover short cash secured puts, you're missing out on even more. So in order to understand the wheel strategy, this is really for generating a continuous income on the investments in your portfolio, right? So you have your trading portfolio and then you have your investment portfolio. Your investment portfolio is typically something you use for the longer term. These are stocks or ETFs that you're buying and holding for months at a time, potentially years at a time. And what we're trying to do is help you understand how to generate additional income on the investment portion of your portfolio. So both of these two strategies today, both of the two strategies on this slide are for your investment portfolio. We're going to talk about a third strategy later today that's going to be for your trading portfolio. But for these two, this is for where you hold the majority of your wealth and you want to focus on generating income for that part of your strategy. Okay, so what we're going to talk about is cash secured puts, the purchase stocks or ETFs at a discount, and number two, how to generate income while waiting for the capital appreciation of those stocks or ETFs that you hold in your portfolio. Does that make sense, everyone? Please type one into the chat window if you're following along with me so far. Okay, perfect. I see a lot of ones. Great. Okay, so let's talk about what is a cash covered put to start off with, because whenever you want to buy an investment, whether it's a stock or ETF, you need to have set aside cash ready to buy that stock or ETF, right? And what you're doing typically, if you're not an options trader, is you're placing a limit order. So, for example, if you want to buy 100 shares of Apple, you place a limit for order to buy 100 shares of Apple. In order to place that limit order, you need to have the cash in order to do so. So, whenever you're thinking about buying an investment with a cash secured put, you also need to have the same thing. That's why it's called a cash covered put. You need to have the cash that's required to buy 100 shares of the underlying security. And what this allows you to do is sell a put option, allows you to sell a put option using the cash as collateral. And what it does is it pays you income. And a limit order doesn't pay you any income. A cash secured put pays you income. And when you sell that cash secured put, it creates an obligation to buy the stock or ETF at a specific price, which is the exact same thing that you have when you place a limit order. When you place a limit order, you have an obligation to buy the stock at a specific price, with the cash, and you have to have the cash in collateral in order to place that limit order. So a cash secure put works very much the same way. But the difference is that you get paid income. And a cover call is what happens once you own 100 shares of that specific stock. And both cash secured puts and cover calls, you need to trade in 100 share increments. And I know that not everyone has a portfolio that's large enough to always trade 100 shares in every single stock that you want to purchase. So if you have a smaller account, this is a strategy that's only suitable for the stocks that you can afford to buy 100 shares of in your portfolio. I'm going to show you how you can use our tools to screen for lower price stocks that are high yielding to do exactly this, even if you have a smaller portfolio. Okay, so once you acquire 100 shares of a stock, what do you do with that? You typically just hold on to the stock and wait for it to appreciate in capital. Maybe you're also collecting some dividends while you wait for that capital appreciation, but the dividends is the only income that you have to show if that stock pays any dividends. If you have a non-dividend paying stock, there's no income, there's no income stream while you wait for that stock to potentially appreciate. So you could be waiting for a long time. It could be a few months, it could be a few years before it reaches your target price. What we're trying to do is help you extract income month after month while you wait for that capital appreciation. So what you have to do with the cover call is you're going to sell a call option using the 100 shares that you own as collateral, so that you don't have to post any margin in order to sell that naked call. And what you're going to do is you're going to receive the income from selling that call. And by selling the call, what it creates is an obligation to sell the stock at a specific price sometime in the future. The same obligation that you have if you were to place a limit order at a higher price, waiting for that stock to appreciate. So what we're going to go over today is an example of a cash secured put and a cover call using a real stock that we have in our bullish buy list here right now. And I want to walk you through how much income can you generate, what the outcomes are if you sell a cover call and a cash secured put versus buying the stock outright using a limit order. And I want to show you tools as to how you can find trades just like this using the OptionsPlay platform. Okay, so let's start with the stock investor. Let's say you own stocks today, or you're a stock investor, and we recently just put out a buy research piece on AMD. I think it was 2 weeks ago. So this is a great time potentially to look at this stock as a potential buying opportunity. And, this stock has really taken a bit of a beating here, certainly a leader in the semiconductor space. And we all know the concept of buy low, sell high. And I think this is a prime example of potentially an opportunity to buy low on a stock that seems to be quite favorable from both the technical and fundamental perspective. So let's say I want to buy the stock at around 120, and let's say I have a target price of 140 on this particular stock. So AMD is currently trading around 120. I think it's going to reach 140. As a stock investor, I place a limit order to buy 100 shares of the stock at $120. And what would happen is I would be risking a total of $120 per share to potentially make $20 per share. That's my risk to reward. And once I own the stock, I'm basically collecting dividends and I'm exposed to AMD until it reaches $140. Now, AMD doesn't pay any dividends in this particular case, so I'm actually not receiving any dividends. I only have the exposure to the stock, hoping that the stock will reach 140 before it declines too much in value. Right. So I think this is a scenario that most of us understand, correct? Please type 2 into the chat window if this is a scenario that you understand as an equity investor. And I would imagine most of you have a pretty good understanding of stock investing. Perfect. Okay. So what we're going to do is I'm going to show you the alternative to this. And this is, remember, the number one most underutilized option strategy for long-term investors. Many of you sell covered calls, you don't sell cash secured puts. I'm going to show you the difference between the two and how much income you can potentially miss out on. So what we're looking out at, and I pulled these numbers from yesterday, so these are up to date prices. If you were to sell a 30-day put option at the 120 strike price that you would have placed a limit order, right? So we want to buy the stock at 120, so we're going to sell the 120 put. It obligates us to buy the stock at $120 if in 30 days the stock is below that specific price. How much income can I collect in 30 days by obligating myself to buy the stock at $120 is $6 worth of income. On a $120 stock, that's 5% of the stock that you're earning in just 30 days. Think about what that annualizes out to for the full year. Not 5% per year, 5% in 30 days. That's how much yield you're earning on the cash that you are setting aside to potentially acquire these shares. There's nowhere else that I know of where you can generate 5% yield on your cash just to buy the stock that you are looking to purchase at the same price that you're looking to purchase it at if you were to place a limit order. And what happens is now, once you sell that cash secured put, immediately your risk on the trade, if you were to get assigned on this, is lowered to $114 per share. It actually is lowered to $114 a share, whether you're assigned or not, right? Because even if you're not assigned, you collect the $6 of income, you can sell more. And what that does is it continuously reduces the total risk that you're taking on the investment, right? So if I sell one put option and it gets assigned to me, I risk now only $114 per share versus $120 per share as an equity investor. My reward now increases up to $26 per share. So my risk to reward shifts by a pretty substantial margin. We're talking about 5% in 30 days without changing the outcomes of the trade, right? As long as the stock I'm able to purchase at 120 and sell it at 140, I'm only going to risk 114 to make 26, as opposed to risking 120 to make 20. And what this does is it generates approximately $6 a month until AMD reaches 120. What do I mean by that? If, let's say, AMD is not below 120 next month, what I can do is I can sell another 30-day option, maybe at a different strike price depending on where the stock is, but I can generate another roughly $6 of income if the stock doesn't reach 120 by my expiration date and I want to sell another cash secured put. So I still want to acquire the shares, but I didn't acquire it this time. So I'm going to sell another put option and maybe collect another $5 or $6 per month on this. And what it does is every single month I sell it, I'm going to reduce my cost basis on the trade by approximately 5% of the stock's value. So even if the stock gets acquired on the first month, I'm getting a 5% discount on my stock purchase by selling a put option versus buying a limit order. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Okay, and these are real numbers. This is not a fake number I just made up. 6 is rounded up, actually rounded it down a little bit. But you'll see that yesterday you could collect a little over $6 in income on selling a 30-day at the money put option on AMD, which is a stock that we currently have a buy. Is in our buy list on our research report, and that's another thing that you get with your free trial or membership here at OptionsPlay is weekly technical and fundamental research of our best stock picks. And AMD, for example, was one of the ones from a couple of weeks ago. So if you want to sell a put option on any stock that you're interested in, the rule of thumb is to sell roughly 30 days out. And what you want to do is you want to sell a put option that's close to the current price of the stock, roughly about a 40 delta. 40 to 45 delta is usually a good starting point. And so when the stock was trading at 120.79, we were selling a 120 put. We're selling the January 31st 120 put. And as you can see earlier yesterday, it was collecting $6.28. So collecting a fair amount of premium on that, a little over $6, which is yielding 5.5% in just 30 days. If you annualize that over the year, that's 92% annualized yield on the cash that you're setting aside to potentially acquire those shares. Like I said, you're never going to see yields numbers anywhere close to that anywhere else, just to acquire the shares that you want to buy, which is why I call this the number one most underutilized option strategy in the world. Because most traders that are buying stocks based on, research reports that you're reading, that you're thinking about buying, you just outright place that limit order and you're missing out on a lot of yield, on a lot of cash. You'd think that, think about like, what if you can get about a 5% discount on every stock purchase that you can purchase? What would that do for your return in the long run? How would that improve the outcome of your trades? It's a pretty significant change, right? So the rule of thumb is 30 days at the money, 40 delta put option, and the rule of thumb is to collect at least three times the dividend yield of the stock. Here I'm collecting 92%, right? So even if AMD paid a dividend, even if it paid a nice dividend of 5%, you'll see that 92% is way more than three times the dividend yield. So if the stock paid 5%, you're usually trying to generate at least 15% yield on the cash secured put in order to justify the risk of the cash secured put. Okay. And a question saying, how do I know what the delta is? It's on the strike drop down. So when you click on the strike dropdown, it'll tell you the delta of each strike price. Okay, just like how um, an options chain would tell you the delta of a screen. Okay, so what we have built here at OptionsPlay is a short put scanner. What that means is that AMD was a trade that we had in our research report, but what we also have built into the OptionsPlay platform are a scanner that updates every single hour based on the highest annualized yield short puts for all liquid stocks or ETFs. And the reason that we only scan for all liquid stocks and ETFs is because we only want to show you opportunities that you can execute from an options trading perspective. There's no point in me showing you some short put that yields, 300%. That's, not very liquid, that you can't really trade in and out of. So we only scan for, stocks that are very liquid. There's usually about 400 or 500 names in that list. It's a pretty big list. And we are looking for the 30-day 40 delta cash secured put across all 500 plus securities and ranking them based on where you get the highest yield. And this is something that you can find on your OptionsPlay platform under the ideas section. On the very upper left-hand corner under ideas, you will see a section here, a drop-down menu that will help you select the different types of ideas, and you can go to short puts. Okay, and by selecting short puts, what you can do is, what we sorted is based on yield. So what you can see is, as you can see, the top one has 104%, Super Micro 104%, Mara Holdings 98%. And one of the things that you can do is you can look at just the stock price, right? So $27, $30, $17. These are suitable for those of you with smaller portfolios, right? Because sell one cash secured put on Mara, you need about $1,700. You actually need less than that, but you need a little under $1,600 in order to sell that. But obviously, MicroStrategy trading at $300 might not be suitable for every single portfolio, because you need close to $28,000, $27,000 in margin to sell that, right? Tesla, obviously a high price stock, but you can go down this list and only look for the low price stocks. You can also sort it based on stock price as well. Premium, right? So you can sort it by premium, meaning where do we get the smallest premium? And that's usually where you get the low price stocks here as well. Okay, so Macy's is a good example. 33% yield, $16 stock. SLV 25, $26 ETF, 25% yield. Baker Hughes 34% yield, $41 stock. So you can find these low price stocks by sorting based on premium. But if you just simply want the highest yielding opportunities, I usually just keep it based on yield, and you can easily go down the list. So for example, if we look at Mara Holdings, $17 stock. If you click on it, what it'll do is it'll show you exactly what contract to sell. It will at that point pull up the real-time pricing. If it's open at the moment, the market's obviously closed right now, so these are closing prices. And what it will give you is the current most up-to-date pricing. So you're collecting 8.84% in 30 days, which annualizes out to 190 percent at the moment. So Mara Holdings, and these might be after our pricings that are distorting these prices a little bit. So let's look at something like, I don't know, Robinhood. Robinhood's up 5% today. Wow. Probably based on some kind of move on Bitcoin. As you can see, this is generating 6.29% yield in 29 days, which is 115% yield. So if you look at this stock, right, and you're saying to yourself, okay, I think, crypto can continue to run. Robinhood's doing a lot these days. You think that, this pause is probably an opportunity to buy this particular stock. Well, now you can sell a 38.5 put option instead of placing a limit order, collect $228 for every 100 shares of stock you're willing to purchase, and that generates 115% yield on your cash that you're setting aside to potentially acquire these shares, right? So, like I said, a lot of opportunity here. And many times, most investors are not utilizing the strategy enough, in my opinion. Does that make sense, everyone? Please type one into the chat window if that makes sense to you. Perfect. Okay, so now let's say you sold the cash secured put and now you own 100 shares of AMD. Cover calls, I think most of you are familiar with. That's where you're selling a call option against 100 shares of the stock that you own. And what you're trying to do is you're trying to collect income on the stock that you own while you wait for it to appreciate. So let's say instead of placing a limit order to sell the stock at 140, you sell a 45-day call option at 140. And what that's going to collect is roughly $3 worth of income, about half the amount of income that you're going to get on the cash secured put. And this is due to the mechanics, and we'll talk about some of those mechanics and best practices. But what happens is once you sell this cash secured put, you're further going to reduce your total risk that you're taking on the trade. We're going to reduce it from $114 a share down to $111 per share because we're generating another $3 worth of income. And we're going to increase our potential reward to $29 a share versus $20 per share. So for the same move from 120 to 140, instead of making $20, we're going to make $29 if that happens. And if it doesn't happen, if the stock were to go to zero in some unfortunate manner, then you're risking $111 versus $120 per share in that particular example. And you're going to generate roughly $3 a month, or $3 every 45 days to be more exact. And you're going to collect dividends if AMD does pay any dividends until it reaches your target price of $140. So this is a good example of how you can use the wheel strategy to buy investments that you want to purchase in your portfolio and use it for stock purchase. And once you've purchased the stock, to generate continuous income on that asset until it reaches your target price. So the minor differences between cover calls and cash secured puts. When you're selling cover calls, you generally want to go a little further out, about 45 days to expiration. You want to reduce the number of opportunities throughout a 1-year cycle that you have the stock potentially be called away. And at the same time, you want to select expirations that have a fair amount of time decay. So 45 days is kind of the sweet spot for cover calls versus cash secured puts. You want to potentially be acquiring the shares more frequently. That's why you sell a shorter dated option for cover calls, cash secured puts, and a slightly longer dated option for a cover call. But the one difference between a cover call and a cash secured put is that a cash secured put, you want to sell a strike price that's relatively close to the current price because you want to maximize income and you want to maximize the probability of owning that stock. But with a cover call, what you want to do is the exact opposite. You want to sell a strike price that's pretty far away from the current price of the stock. You want to sell something that is only about a 15 delta, a 15% chance that the stock is going to be above your strike price at expiration. 10 to 15 deltas is usually a good starting point because the most important thing when you own the stock is not income anymore. The most important thing that for you when you own the stock is capital appreciation. You have to have the stock. If the stock were to run in a particular month, you want to capture as much of that as possible. You don't want to get caught out where you've sold the stock too early after when the stock takes a big run in a specific month. That's why when you're selling covered calls, you must sell covered calls that are much further away. That's going to collect less income. But like I said, once you own the stock, income is going to be secondary to the capital appreciation of the stock itself. Because here, as you can see, if I were to sell that February 21st 140 call, I'm collecting $140 for every 100 shares, right? Think about what is the potential gain if the stock reaches $140. It's $2,900 for me per 100 shares versus $140 in income. So what I can get in capital appreciation far outweighs what I can generate in income, which is why it doesn't make sense. Sometimes people will sell a 130 call option, right? And what you're doing is you're giving up $1,000 in potential capital appreciation in exchange for maybe an extra $100 in income, right? And that's just a recipe for underperforming in the long run. So whenever you're selling covered calls, you want to select strike prices that are far away that you think that, hey, this stock really needs to run a lot this month in order for the stock to kind of call the way. That should be the feeling that you have when you're selecting strike prices. When you're selecting a covered call versus a cash secured put, it should be the opposite. You should be selecting strike prices very close to the current price where you have a pretty strong confidence that that cash secured put will get put to you or assigned to you at expiration. Does that make sense, everyone? Please type 2 in the chat window if that makes sense to you. Perfect. Okay, so those are some of the important mechanics that you should understand about a covered call versus a cash secured put. And just like the cover cash secured put, we also have a cover call screener, right? So, and the cover call screener is built in a way where obviously you only want to sell cover calls on stocks that you own, right? It doesn't, who cares that Robinhood generates 62% yield on a cover call if you don't own the stock? So what you can do is you can sort this list based on stocks that you have in your watch list or stocks that you have in your portfolio, right? So let's say I'm looking at just the stocks in my watch list. What we'll do is so if let's say you have a watch list of all the stocks that you have 100 shares of, you can just click on a single button and see the top performing cover call opportunities in your portfolio. So Bristol Myers, that's one of the stocks in our buy list here right now. As you can see, this is selling the $58 call option expiring on February 14th. That's going to generate in this particular case, it'll generate $2.15 worth of income for this particular strategy, right? So it generates a $215 worth of income if the stock closes below $58 on the February 14th expiration. So this allows me to quickly understand how much income I can potentially generate on the stocks that I own in this particular case, and I can go down the list. And the rule of thumb is that generally you want to generate at least 2 times the dividend yield. So as you can see, Bristol Myers pays a nice 4% dividend yield, but here I'm collecting 38% yield on the cover call. So more than double the dividend yield, even in a high dividend yielding stock. Let's look at CVS. Maybe CVS is not the best example because I don't think a lot of customers own that, but maybe Uber is a good example here. The stock's trading at 63. We're selling a $72 cover call. And let's look at this real quick. So we're generating $128 worth of income for every 100 shares if the stock closes below $72 at expiration. So $72, as you can see, is all the way up here, right? The stock has to recover quite a bit of this recent fall in order for it to get called away. So that's kind of the philosophy of these cover calls. If you want to sell a cover call that's relatively far away, the stock really has to make a big run before the stock gets called away. And that's how you have a successful cover call strategy in your portfolio. This way you can get the capital appreciation that you're looking for in the underlying stock while still generating a fair amount of yield. So as you can see, Uber, you're generating nearly 19% yield while you wait for your stock to appreciate. So even if throughout the year the stock never reaches your cover call strike price. If you consistently do this week after week, month after month, you're still getting a 19% return on this stock at the end of the year, minus any potential capital losses that you might have on the position. So even if the stock is down 20% at the end of the year, you're basically flat on the year because you've generated 19% yield by selling cover calls. That's a great way to also provide a little bit of downside protection if you do have a stock that's trading sideways or slightly to the downside in a particular year by selling cover calls, and mitigates that downside risk to some degree. And then if the stock really takes off, you're also able to take profits and generate income while you do so. Okay. So as you can see, we have both a short put and a cover call screener that automates all of this work that I've shown you here so far, right? So as long as you know this is how you want to, these are the strategies that I'm going to deploy, we have the tools that automate every single step for you. It selects the expiration date, the strike price, calculates the yield for you. So within a couple of seconds, you can instantly decide, is this enough yield to justify the risk that I'm taking for my portfolio? Okay. And lastly, what we want to talk about is a directional strategy, a credit spread vertical strategy. This is for an income generating strategy for when you have a directional view on a stock or ETF. We recently put out a buy opportunity on Boeing, and what this gives you is a forgiving strategy with a higher probability of profit that's going to help you build confidence with limited risk and limited reward. So this is a great trading strategy where you don't need a lot of capital outlay. It's usually a very small capital outlay to take a directional view and generate income while you do so. It's a high directional, high probability of profit strategy. So to sell credit spreads, the rule of thumb is that you generally want to have a 45 days to expiration. And the only thing you really need to truly sell a credit spread is a loose directional view, right? So I'm looking at this chart, and there's a pretty clear uptrend that it's been in for the last month and a half. That's really all I need in order to justify selling a credit spread. It's either in a downtrend or an uptrend. It doesn't have to be a strong downtrend or a strong uptrend. It just has to be in some form of a trend in order for me to have the confidence to sell a credit spread. And what we're doing is we're selling an at the money call or a put, and then buying back a call or a put that's a 25 delta. Now, because this is a bullish strategy, I'm going to be selling puts. If this is, for example, a bear strategy, I'm going to be selling call options. And so what I'm going to always do is either sell the at the money put or at the money call, and then buy back a 25 delta call or a put against it. Now, I have a long video, a specific video just on credit spreads. So if you're not familiar with credit spreads, and the language that I'm telling you about right now is new to you, we're going to show you how you can watch a full video that gives you a full breakdown of a credit spread as if you know nothing, to help you better understand this specific strategy. But the rule of thumb here when you're selling a credit spread is that you must collect 1/3 of the vertical width. So if, let's say, we're selling the 175, 165 put vertical, where we're selling the 175 and buying the 165, that's a distance of $10. We want to collect at least 1/3 of that, which is $3.33. Here, as you can see, I'm collecting $3.77, which is more than 1/3 of the vertical width. So that's a rule of thumb that you generally have when you're selling credit spreads. But the second rule of thumb that you generally have is that you want to also take a look at it from a timing perspective, because while you can sell credit spreads at any point in this particular trend, the most optimal time to sell it is when you have a bit of a pause and a little bit of a pullback. A bit of a pause and a little bit of a pullback, those are the best opportunities to sell these credit spreads, because even if you didn't wait for the pause, right? Let's say you sold it at the top here. You will still end up being profitable on the trade, but you might have to sit through a few weeks of kind of chop and maybe a few weeks of small losses before the stock turns back into a profit, right? So even if you kind of have really bad timing, let's say you sold the credit spread here, and you might have sat through a bit of pain through that trade, eventually a couple of weeks later, you would have been profitable on the specific trade. But from a timing perspective, you do want to be more optimal, meaning waiting for pullbacks in a bullish trend or wait for rallies in a bearish trend. So, when you think about kind of optimal credit spreads, you have to think about optimal credit spreads from an options pricing perspective, and then you have to think about optimal credit spreads from a timing perspective. And that's really where we built a fully automated credit spread opportunity tool. basically what we're doing is we're screening for credit spreads that generate more than the 33% of the vertical width, which is the minimum rule for selling credit spreads. We're only viewing it on very liquid underlying symbols so that you know you can execute these trades at the midpoint or very close to the midpoint. And number three, we're only showing you credit spreads where these rules are met and it aligns with our technical directional view, meaning we're waiting for that pullback in a bullish trend or we're waiting for that rally in that bearish trend, so that all three things that I just taught you about selling the optimal credit spread has been fully automated for you. And you can find that in our credit spread report. So under ideas, you have technical ideas, you have short put ideas, you have cover call ideas, and you also have credit spread ideas. So what this does is it helps you find the best credit spread ideas that aligns with a trend. And I think Tesla is probably a good example of this, right? This is a stock that's very much in a bullish trend, but has recently taken a bit of a pullback here, right? So as you can see, like if you think about this, this chart that I showed you before, right? Let me pick this up here. You have a stock that's in a bullish trend, but recently has pulled back. And what you're looking for is a potential restart of that bullish trend, right? Do we know if Tesla's going to restart that bullish trend? No one knows. But what we're waiting for is a bit of a pullback here. And this gives you the best possible risk reward. And that's what we're getting here in Tesla. So if we sell the 375, 340 put spread, we're going to collect $14.73. Let's do a little bit of math here. 75 minus 40 means that there's a vertical width of $35. We're collecting $14.70 out of the $35. That's 42% of the vertical width. The minimum is 33%, but here we're collecting 42% of the vertical width. So not only have we found a trade that has found a very high percentage of the width that we're collecting, because the more we're collecting, the less we're risking, right? So here in $1,400 worth of potential reward, we're risking $2,000 on the back of it. Whatever you potentially earn, the rest of it is your risk. So the more you earn, the less you risk, right? So that's what we're doing. We're trying to collect this. The higher percentage of the width we collect, the less we risk. So as you can see, Tesla, 43% of the width that we're collecting. So we're collecting a very high percentage of the width, meaning we're risking less. And we've been very patient, right? We're not just saying we're going to sell Tesla puts at any time. We want to sell Tesla puts when it's in an uptrend and has recently pulled back. That's exactly what we got here today. And that's why it generates a credit spread here right now. Now, some of you might say Tesla is a little bit too high of a stock. I don't have $2,000 to risk. So let's take a look at some lower price opportunities here. Let's look at XLE. Now, this is the energy ETF. Sorry, I'm losing my train of thought here, right? Clear downtrend, recent pullback here, recent rally here in that bearish trend. Is this going to continue lower? We don't know, but we certainly have all the probabilities aligned as much as possible in our favor. So this is selling the 86.5, 91.5, right? So that's a $5 wide credit spread. We're collecting $2.11 out of $5. So we're collecting here again, almost 42% of the vertical width that we're collecting here, right? So not only are we collecting 42% of the vertical width, we're also, from a timing perspective, waiting for that rally and looking for that potential continuation lower here. So as you can see, the credit spread report automates everything that you need in order to find these ideal setups for selling credit spreads that are only in liquid stocks that you can execute almost immediately on in your portfolio. Okay, so I've gone over a lot of things today, right? We've covered 3 option strategies. A lot of these sessions, we cover just one strategy. We go in depth into these strategies. But today, what we've done is we've gone broad. We've shown you kind of a range of strategies. And I did this on purpose to start off the year, because many of you are thinking about your strategies for the year. You're thinking about your portfolios for the year. It's important at this point to kind of think through what are the potential options to start looking at where should you fill in the gaps in your portfolio, right? And that's what today's session is meant to help you better understand. So If any of the strategies today that I showed you is new to you, not only do I want you to learn more about it by finding those full videos on our YouTube channel, because we have full videos on the wheel strategy, full videos on just cash secured puts, videos on just cover calls, and videos just on credit spreads. So I want you to learn more if you're uh, try to fill in any gaps in your particular portfolio. But once you kind of start learning, one of the things that you can do is start paper trading these trades in OptionsPlay. So what you can do is you can create a portfolio in your OptionsPlay platform, and you can add positions to this paper trading portfolio, and you can track the P&L on it for the positions. So, for example, if you're using the OptionsPlay platform, now when you go to the click on the trade button, as you can see, you can create a new portfolio. If you don't have it already created some portfolios, you can see I have a bunch of these portfolios already created. I have my CNBC trades, I have my cover call portfolio of my weekly income, my paper trading portfolio, and you can track all of our daily plays as well. That's a global portfolio that everyone has access to. But you can create as many of your personalized paper trading portfolios as you like. So let's say you create one, you call it the paper trading portfolio. Whenever you have a trade that you're thinking about learning or you want to find out more about, what you can do is you can just say, okay, let me add this to my paper trading portfolio, add this position. And now what you can do is you can go to your portfolio tool here on the upper right-hand corner. Some of you have been asking about this. It might look a little hidden. You just have to move that arrow button and you'll see that portfolio. If you click on portfolio, you can bring up your paper trading portfolio. So let's take a look at my paper trading portfolio. And what I'll be able to see is that XLE credit spread that I just sold, right? And you can click on it and you can see kind of how it's doing. It'll show you the current position. You can even make adjustments to it. You can roll the position and see kind of what that roll looks like. So there's a lot of things that you can do with a portfolio tool that some of you might not even know of, but it's a full-fledged paper trading portfolio that you can track all types of positions in, whether you want to start selling some put options and track how they do, whether you want to sell some cover calls or just, try out some of the credit spreads that we have in our portfolio. All you have to do is go to the ideas platform, ideas section, click on a short put that you like. Let's say you want to sell that short put here on what's a good one? Robinhood. Let's say you want to sell that short put on Robinhood, right? So you click on the short put, you click on trade, select your portfolio. Maybe you want to put it in your weekly income portfolio. You click on add position, and that's all it takes to add it. Now, let's say you get executed at a different price. Let's say you sold the January 3rd 38.5 put, and let's say you got executed at $2.20. Well, you can type that in, $2.20, and add that position. And now the position that's added will be added at $2.20. So if you get executed on a real portfolio at a different price, you could also use this to track real executions that you have at your brokerage firm. So a lot of different capabilities that we have here at OptionsPlay to help you take what you've learned, practice it before you apply it in your real portfolios. Like I said, these sessions are really focused on helping you grow as a trader, help you become a more confident trader, and make sure that you grow your account in the long run. And these are the tools that we have in place here at OptionsPlay that can help you achieve that. Okay, so just remember, you have 3 different optimized income ideas with OptionsPlay: short puts, cover calls, cash secured puts. Short puts are, you can base it on your watch list, sort it by income yield. Cover calls, base it on your portfolio, sort it by the income yield. And credit spreads, you just want to find credit spreads that have the highest premium to width ratio, because that means you have the best outcome for that specific trade. Okay, with that, what I want to do is I want to open this up for Q&A, but before I do, I want to remind everyone, if you don't already have access to this platform, if you don't have access to the tools that I showed you here today to help you screen for those cover calls, cash secured puts, and credit spreads, you could sign up for a free 30-day trial at the link on your screen, optionsplay.com/sign up, or point your phone to that QR code on the screen. It takes literally 10 seconds to sign up, and that will give you full 30-day access to everything that I showed you, including the slides and the recording from today's session. And you'll be able to follow us along on our YouTube channel once you get that recording, and look for those other videos that I'm talking about. Cover calls, cash secure puts, and credit spreads. All 3 have individual webinars that I've hosted within the last 3 months. So they're very recent videos too as well. that I've hosted on teaching you each of those strategies. So if you find any of these strategies that you want to learn more about, go to those videos, take the full course on each of those strategies. That's how you're going to be a better trader in 2025. And I really hope that many of you will be able to join us in that journey here throughout the year and come back every single Thursday for these Thursday afternoon sessions to help you improve as a trader. Now, one piece of housekeeping before we get to the slides or the questions is that next Thursday is going to be a market holiday because it's a national holiday to mourn the passing of President Carter. So we will not be hosting a Thursday afternoon session next Thursday. I will also not be hosting a Fidelity in the Money session next Thursday because of that. So we will be resuming 2 weeks time from now to kick off earnings season. So next Thursday there will not be a session. I hope we get the message out to as many people as possible because I know many of you come every single Thursday for these sessions. Every single time we have to cancel or there isn't a session, we always get a lot of emails from people saying, "Hey, where's the session?" So I just want to remind everyone, no session next week because of the market holiday. So let's turn this over to Q&A. There's a Q&A window and a chat window at the bottom of your screen. Can you please type your questions into the Q&A window, and I will try to answer as many questions as I have time for. Joshua, your question about not being able to get a response from us, please, Joshua, the best way to, if you can't log in, then the best way to reach us is info@optionsplay.com. Please make sure that you reach out to us at info@optionsplay.com. I will kind of just copy your thing real quick to our customer service staff and make sure that they are able to take care of that. But I've passed your information to our customer service staff, but if you have any questions, please email us at info@optionsplay.com. Thank you. In the wheel strategy, seems like the primary goal of selling cash secured puts is to acquire the stock secondary to generating income. Would you recommend using this somewhat on not liquid options? No, I generally don't, unless you really. So here's the thing, right? There's a lot of stocks where the options aren't particularly liquid, but the stocks are. So if the stock trades more than, let's say, 500,000 shares of volume a day, go ahead, sell that cash secured put, even if there's not a lot of volume in the options itself, right? Because you're not trading these very often. But your primary goal is to acquire the shares and generate income because you're selling a cash secured put that's pretty close to the stock price. You're going to maximize income in that scenario. So, Charles, I hope that answered your question. How do you access the buy list from the platform? We email you the buy list every single Monday and every single Thursday, and we host a Monday morning webinar to walk you through the entire buy list. So multiple ways to access it, but you have to have either a free trial or a membership to get access to it. And we email it to you every Monday, every single Thursday. Those are the 2 times a week that we update the buy list. And every Monday, I do a full 45-minute webinar where I walk you through every single security in our buy list so that you have a clear understanding as to why a security is on our bull or bear list, so that if we send you a trading signal throughout the week on one of those stocks, you are prepared and you know whether or not you're going to execute that trade. We want you prepared at the beginning of every single week before the market opens so that the second we send you a trading signal, you're ready to go with it. When is the greatest chance to get assigned an AMD? How much in the money or running out of time value would you get assigned? The greatest chance of getting assigned is at expiration. There's a small chance of getting assigned early if a stock pays a dividend, but AMD doesn't pay a dividend. So in that particular case, your chances of early assignment is pretty low. Are these scans available through the OptionsPlay module on stock charts? No, they are not. What's available on stock charts is a little different. How do you set up a watch list? So when you go to the watch list section, okay, which is on the upper left-hand corner, you can select create a new personal watch list on the drop-down menu, and that will allow you to name the watch list. So test watch list, you save it, and then you can start adding symbols. So IBM, Walmart, Apple. You just type it in and you can add symbols. As you can see, it's pretty simple to add it. So you go to your watch list, create a personal watch list, and just start adding symbols by clicking on this drop-down menu, clicking on the search symbol. Is the rule of thumb for selling cover calls 20 deltas or less? I generally tend to aim for about that 10 to 15 deltas is a good rule of thumb for selling cover calls. Do you have a video example of buying back credit spreads at 50% profit on Thinkorswim? I actually do. It's a pretty old video, Chris, but it's out there on our YouTube channel, youtube.com/optionsplay. It's an OCO bracket order on how to, manage OCO. Thinkorswim is one of the few platforms that allows you to put an OCO bracket order on a complex strategy like credit spreads. But yeah, I do have an example of video on that on our YouTube channel. Do you have a video on how to make adjustments if a credit spread goes against me? No, because once a credit spread goes against you, you shouldn't try to make adjustments. You should simply close out the trade and move on. If you've got the wrong directional view, if you want to take a new directional view that's in the opposite direction of your original one, you can do so, but close out your losing trade first and then think with a clear mind, as to whether or not you want to place a trade in the opposite direction. You don't want to throw good money after bad money. So clear the trade, remove the bad trade from your mind before you think about whether or not you want to place a new trade in that strategy. A lot of times what we find is that people are just chasing good money after bad money, trying to make back what they've lost. And the next thing whenever you put yourself in that mentality, you start to potentially lose a lot more money than you originally intended to. It's a bit of the gambler's mentality of like, I'm losing money, so I gotta gamble more to try to make my money back. And that's never a good position to be in. So close out the losing trade. Think with a clear head. If I wasn't in a losing trade, would I place a trade in the opposite direction that I had in the losing trade? 9 out of 10 times the answer is no. But sometimes the answer is yes. But as long as you're thinking with a clear head and you're not doing it, as Jim calls it, a revenge trade, then you absolutely can do it. But just make sure that you're not revenge trading. Um, what is the stop loss guidance for each of these strategies? So for cover call and cash secure put, there's no stop loss. The only thing that you're thinking about from a cash secure put is really a pretty simple strategy. You sell it and you just wait for it to expire. Is there a point at which you might want to say, I no longer want to buy this stock? Sure, but that's kind of another decision you have to make. If the stock, some new information comes out and the stock drops 20%, you're thinking to yourself, I no longer want to buy the stock. Sure, you would definitely want to get out at that point, but that's not really a stop loss per se, right? That's just, I don't want to buy the stock anymore. Same thing with a cover call. If for whatever reason new information comes out while you're holding onto the stock, then all of a sudden you're saying, I no longer want to buy, I no longer want to hold the stock, sell the stock, sell the cover call, get out of the cover call, right? But you don't really have to manage the puts and the calls separately other than the underlying security itself, right? And then for credit spreads, there are very specific rules for when to take profits and cut losses, and that is in that full video on our YouTube channel. I just posted that video pretty recently here. I can probably find it real quick. Is this in 1 second? I just posted a link to the video on growing your account with a credit spread strategy. So I both posted that link to the chat window. So if you want to find out more about that, which I saw a lot of questions about it, feel free to watch that video. I've got enough time for a couple of more questions here. How do we select the bid ask price for the XLE credit? So, whenever you're trading anything from our scanners, like I said, we've already screened the liquidity for you. You can pretty much place orders at the midpoint. If you need to, you might have to move. If, let's say, you place an order at the midpoint, it's just sitting there, right? Sitting there for 5 minutes, 10 minutes, it's not really getting filled. You might want to move it maybe 1 or 2 pennies off that midpoint and see if you get filled there. Most of the time, with a very liquid symbol like the ones that we're selecting here, during market hours, you should be able to get filled either at the midpoint or no more than 1 to 2 pennies off that midpoint. Um, You mentioned the research papers, is that the loft list? Yes, that is. We're going to be renaming that just to be something a little bit more easier to understand. It's going to be the trade ideas list that we put out every single week. That's coming in the next couple of weeks or so. But yes, it's what we've traditionally, historically referred to as the loft report, which is the liquid options fundamental and technical report. So it's the content of the report's going to stay the same, right? Meaning these are liquid stocks that have options traded on them, that have both a technical and fundamental thesis that aligns with one directional view. That's still gonna be the content, but we're gonna rename it the Trade Ideas Report just to make it a little easier to remember and understand. Um, how do we predict correctly the direction? You can't. Like no one can, right? If anyone can correctly predict the direction, there would be no market. So no one can. It's all about putting the probabilities and odds in your favor as much as possible. And that's exactly what these reports do, is they find you the highest yielding opportunity. So you're getting the largest downside protection, the highest amount of yield, so that if if the trade goes against you, you have the most protection as possible, right? If you do that on every single trade, some trades will have losses, but the trades that hope the goal is that when you have wins, they will offset the losses because the wins will be larger than if you didn't use these strategies, and the losses will be smaller than if you didn't use these strategies. You selected 140 for the AMD from our list. What's the guidance on selecting a target or strike price? So that's really what the OptionsPlay platform does for you, right? You go to the cover call screener, right? Let's say you're looking at stocks that you own in your portfolio or in your watch list, and for example, Robinhood, right? We will tell you exactly which credit cover call to sell. The 42.5 cover call to sell that has about a 10 delta. That's gonna how you're gonna select your strike prices for these types of strategies. Rick, if your questions about how to create a watch list and find cover calls and cash secured puts, I've covered that during today's session. So please just watch the recording. You'll get the slides and the recording where I've covered all of that, and you can watch it at your own pace. Is there an all or nothing in credit spreads? Do you make all the profit or lose the max? You can, but generally speaking, no. Generally, you want to take profits before you make the max profit. And you generally will cut losses before you lose the max loss. So I cover all of that in the video in the link that I just posted in the chat window a few minutes ago. When will you send out the video? We always post these videos on Sundays, so you will get an email from us on Sunday with the recording and the slides. If you're accessing OptionsPlay through stock charts, you won't have access to these tools, and you won't have access to, the things that we're showing you. You can follow us on YouTube, right? So I suggest that if you don't have a membership with OptionsPlay, the least you can do is subscribe to OptionsPlay on our YouTube channel. So that's youtube.com/OptionsPlay. I will post a link in the chat window. YouTube.com/OptionsPlay. The least you can do is subscribe to us on YouTube. That's going to at least get you updates whenever we post a new video. The slides are included in the description of the video so that you can at least get that if you don't have a free trial or a membership. Okay, I'm gonna answer one more question and then I have to run. And so there's a few questions about if you access OptionsPlay through your broker or some other platforms. again, you don't have access to all of these tools if you're accessing it somewhere else. You need to have a direct membership with OptionsPlay. But if you're accessing OptionsPlay through a broker or something like that, then my suggestion to you at the very least is to subscribe to us on YouTube so you get updates from us when we post these videos. Yeah, a couple of questions for how to get educated on access and on our platform and access your videos. YouTube.com is definitely going to be the right one in the link that I just sent out. Um, is there a list that tracks the daily options play returns? Yes, it's under the daily play portfolio. It's under the portfolio section. There's a global portfolio called Options Play, Options Play Daily Play, and that's how you can get that as well. I saw a lot of questions about the options play score, so I'll answer that and then I'll wrap this up for today's session. So the options play score, the inspiration for that came from playing poker because just like just like playing poker, with every options trade, you have to decide whether you want to play it or you want to skip it, if you will, right? It's kind of like whether you bet on a specific hand or you fold. And how you decide to bet or fold is based on expected outcome, right? What is the probability of winning, and what is your risk to reward ratio if you were to win or if you were to lose. And what we're looking at is kind of that ratio, right? The combination of your probability of winning versus the risk to reward. We're looking at the two in together. Because if you just look at probability or if you just look at risk to reward, you're only looking at half the picture. The poker player is looking at both sides to decide whether they have an edge, a positive expected outcome or a negative expected outcome. And that's how they decide whether they're going to play the hand or fold, unless they're bluffing. So what we're doing here is we're basically looking at expected outcome and saying, do you have a positive edge? Do you have a negative edge? Or do you have no edge at all? And that's kind of what the color coding is. Green means you have a slight positive edge, right? Expected outcome is positive. Red means expected outcome is negative, and orange means that, or yellow means there's no edge whatsoever. Green doesn't mean you're going to make money, and red doesn't mean you're going to lose money. But if you constantly trade red strategies over and over and over and over again, you do 100 trades that are all red, your expected outcome is going to be negative using the law of large numbers, right? So it doesn't tell you whether you're going to make money on that specific trade, but it is going to tell you that if you continue to make trades like this, what is the expected outcome in the long run if you make hundreds of trades, if that makes any sense. And that's kind of how the options play score works. Okay, so with that, that covers what I have time for here today. I really hope that this is a good start for you for 2025 and putting you in the right direction on strategies that everyone can utilize in your portfolio to help you generate income in 2025. These are strategies that anyone who has an options account should be familiar with and thinking about adding to your portfolio in some way, shape, or form for your long-term investments and for your speculative portfolio. And I hope that this puts you on the right path for that to kick off the year. Thank you so much. I hope you guys have a great trading day. Like I said, again, we're not meeting next Thursday, so we'll be back the following week to kick off earnings season once again. Thank you so much and have a great trading day.